All right, good morning and welcome to today's webinar, Real-Time Daily Trading Ideas. 5 days, 5 traders. Today we will be speaking about trading ideas, strategies, market screenings, and we'll be answering your questions. Before we can start with the actual webinar, we will briefly present the risk disclaimer. Trading with financial instruments offered by Admiral Markets carries a high level of risk, which is not suitable for all investors due to their complex nature. Before entering into a client agreement or making a transaction, please make sure to read the terms and conditions of our service. If you are unexperienced with our products or trading in general, please do get used to the trading environment by using a demo account. If you have any questions regarding that, just give us a call and we will be there to answer them all. Alright, this is the schedule for the week. Today it's Jay's turn, just like every Monday of the week. And many of you probably know the reasoning as to why they're trading with us, but just as a quick reminder, we do have best offerings with 0.8 points spread in the DAX and 0.6 pips in the euro dollar. All right, I will be passing over the screen to you right now, Jay. Just a second. Should be able to hear you now. Good morning, Jay.
Good morning, guys. I hope you're doing well. Quick sound check. Good morning, Gare. Good morning, Dees. How are you all doing? Can you hear me okay?
We can hear you, Jay.
Okay, sound is excellent. Thank you very much for the nice intro. Hey, Hendrik, good to see you. All right, let's rock and roll. Let's see what we get going this beautiful, lovely week. What did we have last week? Last week, we were looking to short the New Zealand Canadian dollar. Why? What was the reasoning? We were at the time looking for weaker economic numbers out of New Zealand, and we were looking for stronger economic numbers out of Canada. The risk of the trade was that the numbers would come in differently than what we expected, and or that oil prices would drop after what we call the futures roll. And boy, oh boy, did the oil market drop heavy. It dropped roughly 9% last week, and as you all are aware, we have a UK and US holiday today. Happy Memorial Day to all my brothers in arms and vets. Some of you may know I'm an ex-soldier, so I'm always very thankful for everyone who served so that we have this unbelievable independence and freedom that we have. What did happen to the New Zealand CAD? As you can see, this is the time of our morning meeting last week, Monday. And then this is how the trade developed. And after the roll, which was on Wednesday and then Thursday, we saw that the Canadian dollar saw some significant weakness. And we did see a rebound in the New Zealand CAD. We did hit the target, but we didn't get the swing trader entry. So at the time, you had to be quick on the trigger finger, and as soon as prior day's liquidity was hit, break, hook, and go, and you were still able to make some money. Hopefully, some of you were participating in that good trade. Anyhow, what's the headlines this morning? Risk picture is mixed. As I said, US and UK are on bank holiday, so hopefully, if you are a full-time trader, you are, after this meeting, enjoying a day off, because that's pretty much what we should be doing. In Australia, we saw the equity index come off slightly. Mining names were strong and financial names were weak. The Nikkei, due to some mixed risk picture, we saw the yen come off a bit. So we had the Nikkei recover a tiny little bit by 30 basis points. Trump this morning suggested that a trade deal with Japan can wait until Japan has proceeded with their upper house vote in July. And as we can all watch on Twitter, him and his wife are at sumo events and eating burgers and playing golf with Abe. Anyhow, Hang Seng came off while the Shanghai composite actually was a bit green. We did see some weaker industrial profits in China overnight, minus 3.7% versus 13.9% prior. For the past 3 weeks now, we've seen weakening numbers out of China. It's a bit worrisome because the market is still partially positioned for a recovery in global economic development for the second half of 2019. If that doesn't materialize, then you can pretty much count on equities to sell off heavily over the summer months, which is my current base case. So this number, minus 3.7%, was A, due to higher base effects, so like-on-like comparisons, and B, due to increased production prior to a VAT cut. So people got business in ahead of that. The China MOF plans to restrict direct investment from foreign IT companies beginning in August, and the trade war is looking to shape up into a tech war between the US and China. And that's really what it was all about from the get-go. It wasn't really about tariffs, it was about artificial intelligence and who is going to lead the world in that sector. Is it the US or is it going to be China? And by the way, Russia is the third party in that race. Whoever wins that race wins the next evolutionary stage of an economy. You start out with agriculture, then you go into manufacturing as an economy. The third stage is tertiary, i.e. services, service sector economy, and the fourth one is information society. And whoever wins that race on artificial intelligence. And that's why it will have the global power. And that's really what this is all about. And China is utilizing technology to basically control their entire population. It's very, very scary. George Orwell, back in the day when he wrote his book 1984, would be quite amazed on how much worse his predictions are shaping up in reality. But this should be a trading webinar. Sorry for that, guys. EU elections, as expected, total non-event for the euro. Greece actually may face a snap election afterwards. Why? Because the incumbent party saw heavy defeats, and the PM there actually already said that they may have to go through snap elections. Okay, the Greek economy is the size of the German state of Hesse, so who cares? UK Prime Minister May is out. Crowded race for May's successor has begun. Whoa, uncertainty for the pound continues. It's still difficult for swing trading. It's outstanding and excellent for scalping intraday. Crude this morning, $59 per barrel was rejected. The trade-related fears and bearish inventory data caused a 9%, roughly 9% drop in the prices of last week. And I would play crude from the short side at this very moment. Yes, we have a lot of geopolitical headline risk, but currently different factors are being traded. Daily and iron ore futures this morning surged over 5% over in China due to ongoing supply concerns. So obviously that may be a positive for the Aussie dollar, but the Aussie dollar overall is a short. So hopefully they'll be able to ratchet it up and thin liquidity due to holidays into a top edge so that we can then short it. Fiat Chrysler has submitted a proposal for a transformative merger with Renault, wherein both companies will each own 50% of the group. That's actually potentially positive for Europe, except we're merging an Italian with a French company. Hang on. Wow. God, thank you, God, that I don't work there. My, oh my. That's going to be a pain in the ass for people working there. A pain in the ass. Italian and French together. But somehow the French like the Southern culture. The French banks where I used to work, they always had exposure for Greek banks. And so maybe those cultures work better. German mentality does not fit. So you would never see a merger amongst a French or Italian automaker with a German automaker. Not happening. Anyways, could still be okay for the EU in the long run. And as you all know, with the trade war, the auto tariff threat by President Trump towards the EU, as well as towards Japan, because Japan, their number one manufacturing economy is also the auto sector, auto industry. I kind of like that we have a big powerhouse. Fiat and Renault together would be the third largest automaker in the world. So that's good. We have another heavyweight over here in Europe. Anyway, strength versus weakness this morning. Hey, our buddies over the S&P, as you can see on the top left-hand side, weakened the Swiss franc, probably. And why not? It's a bank holiday in the UK. Liquidity is extremely thin, so it's a perfect opportunity to weaken your currency on the cheap, and that's exactly what they did. So do not wonder, there's no fundamental reason behind it, except that Jordan, the head of the SNB, keeps telling us over and over and over during each meeting, press conference, and any and every opportunity that he gets that the Swissy is overvalued and they would intervene if possible and necessary. And here that looks awfully like an intervention. Besides that, complete mess. You can see no trend. Every single currency is reverting towards the zero line on the left-hand side. And that's completely normal. So the construction day this week will not be Monday, i.e. today, but it will be tomorrow. And then Thursday, some European banks are on holiday again. So it's a messy week. Be quick and nimble if and when you decide to trade this week. What do we have going on? Not that much. On the dollar side, last Thursday, we had much weaker than expected manufacturing and services PMIs, and that caused the dollar index to sell off. The high was at 98.33. That was taken out to 98.37. That was our profit target, was that high, and it beautifully turned around there and then sold off heavily. We made some money shorting dollar versus Canadian dollar. On Friday, we have core PCE. Please recall that that is the Fed's favorite measure of inflation, and expected on the month-to-month to come in at 20 basis points better than the prior reading, but seen unchanged on an annual basis at 1.6%. So 1.6% is obviously not 2%, the Fed's target. The April Consumer Price Index actually suggests that we could see a bit of a softer number, but on the other hand, the PPI input increases, especially in the healthcare sector, could balance this out. The healthcare sector input is quite large for the PCE calculation, and hence healthcare is a difficult topic because it's going to be one of the political topics for next year in the US presidential race. And whereas normally when we have risk of sentiment in the States, and in the equity markets, we have sector rotation, where we go from aggressive sectors into defensive sectors like utilities, for example. In a bear market, everyone needs their electricity, right? Utilities are a long, but usually the healthcare sector is also a long. This year, I'm especially careful towards the end of this business cycle and during the expected sell-off during the summer, which actually already started a few days ago. I'm careful with the healthcare long because of specific political infighting between Republicans and Democrats. That is a sector that I'm not necessarily looking to go long into over the summer or in the next risk-off cycle. Some Fed officials have recently been expressing concerns regarding low inflation. That's important because GDP growth and the rate of change of inflation is the name of our game. Fed's Bullard was on the tape last week stating that if core inflation holds persistently at 1.6%, he would push more aggressively for lower rates to, attention, recenter inflation expectations at 2%. And now it gets really muddy. The Fed is now talking more and more about adjusting inflation expectations in the market. Okay, let me give you an example. When you get married, you have an expectation that your marriage lasts, right? Mathematical probabilities, at least over here, are 54% that you're going to end up divorced. So how can we change your expectation that your marriage is not going to last, but that you have a higher probability that's going to tank? And it's similar difficult for a central bank to change inflation expectations of professional market participants. How do you do that? And it gets murky and muddy. The problem is, if professional participants do not think that inflation will reemerge sustainably above 2%, then we do have a problem, because then that means we're entering into what PIMCO used to call the new normal. And at the time, they weren't talking about inflation, but PIMCO was talking about lower GDP growth going forward because global growth dynamics had changed in their estimation after the global financial crisis. And here's a similar situation. If inflation one of the effects why we don't see prolonged inflation globally is the so-called Amazon effect. If you don't know what that is, please Google it. And B, Western industrialized nations have a population pyramid that's inverting. We have more and more older people who are withdrawing money but not creating new economic growth versus younger people who actually could step in and create economic growth. The way to grow an economy is by capital input, human capital growth, and or productivity increases. Productivity increases are done by technological advances, but we are lacking population growth in the Western industrialized nations. The Fed's inflation target was adopted in 2012, and the magic number here is 2%, and that hasn't been sustainably there in roughly 25 years. So we can see on the left-hand side a month-on-month inflation rate that's dimpling around not 2, not 4, not 3. And then on the right-hand side, we see the annualized inflation rate. That's currently around 2%. At least it came in that way in April. But with oil prices coming off, my traders, we have a lot of my traders in here this morning. If you guys look at the 5-year forward inflation expectation swap, you will see that that tanked even ahead of the oil price tanking. So sometimes the swap leads, sometimes the oil market leads, but the correlation is quite high. So if you want to have a good gauge for inflation, look at the oil market, and that's coming off hard, no inflation. That's why the market is pricing in an over 70% probability that the next rate move by the Fed is going to be a cut until year end of this year. Over to Canada. Last Wednesday, we had core retail sales in Canada, came in much better than expected, but unfortunately, as alluded to several times this morning, oil came off hard. So on the left-hand side, you'll see Canadian retail sales month on month, and that ticked higher to 1.1 versus 1 last time. Then this Wednesday, we have the Bank of Canada rate statement, and the market expects the bank to leave the rates unchanged at 1.75%. Recent data, though, suggests that the economy is performing better than what the BOC had expected. We had retail sales last week coming better. We had manufacturing sales coming better. We had employment change coming in stellar. That was a fantastic number. We have IV PMI coming in better. So we do see some green shoots there. That's why a rate cut, earlier rate cut, was getting priced out of the market. And at the time prior to the roll, the oil market was rising, so the Canadian dollar saw some solid strength. On the bottom and right-hand side, you see GDP growth rate. And you can see that in January, it came off quite hard from 0.5 down to 0.1. What are the headwinds? Well, the Bank of Canada told us that they're keeping an eye on trade policy, on household spending, and on 2 sectors, the housing sector overall and the oil sector, because it's that important for the Canadian economy. The US recently agreed, I think it was last week, and I think I mentioned it last week, to drop metal tariffs, which the Canadians will reciprocate. So part of a trade policy is getting resolved there. But the expectation in the market is that Trump has been stepping back from fighting on the tariff side, implementing tariffs with Canada and Mexico, as well as postponing potential auto tariffs for the Europeans by another 6 months, due to one reason, and the reason alone being he can't fight on 3 fronts at the same time. So he's consolidating and calming down the other fronts, and the market expects him to do so that he can solely focus on the tech war / trade war with China. Obviously, that's bad for everyone if that escalates further, and that means it's also bad for the Canadian dollar. The caveat, specifically to the Canadian economy is investment growth. The bank expects it to remain weak, and we, you and I, we need to keep watching the business confidence. Every time business confidence in, we need to watch it. If it ticks higher, we'll see some Canadian dollar strength. If it ticks lower, we'll see some weakness. Friday GDP is expected to come in at 0.7 annualized in Q1. That's the second consecutive quarterly reading sub 1%. It's a bit worrisome, but on the month-to-month basis, it's expected to tick higher to 0.2 versus a negative 0.1 prior. So that's good. That's actually could be a positive catalyst if the oil market stabilizes. But again, this morning, 59 was rejected in oil. Doesn't look that good. Nevertheless, what's the possible trade opportunity that I'm perceiving? I am looking to short Aussie versus Canadian dollar. Bit tricky, I grant you that, due to BOC this week, rate decision. They could be much dovisher. Don't really expect them to be that. I expect them to be more on the neutral side, and the oil market if it continues to sell off. But I'm choosing a weak versus a weak currency here. I'm not getting married to the position though. If it doesn't reach target and I see the other side coming in ahead of time, I'll take profits quickly. Aussie, weaker Chinese economic numbers, again expected for Friday. And we see some analysts calling for 3 rate cuts in 2019 in Australia down to 0.75. We're currently at 1.5%. I think that was Westpac. Westpac, the first one, calling for 3 rate cuts. 3-year Aussie government yields all-time low. That's interesting. The bond traders are already telling us that they expect lower rates. So keep watching. Keep watching the Aussie. Any top edge is sellable. Canadian dollar, stronger economic numbers. I alluded to that already. The problem obviously is the oil price. That's the risk to the trade, that the numbers come in differently than what we expect, and or that the oil price continues to drop after the roll, which it may. Nevertheless, we are at a top edge. It is trading sort of in a box, so I would look to short 93.30. To be honest, I do have a small starter position short already because it's such a messed up short week. I don't want to miss the trade. My take profit is roughly 100 pips below. I know it looks differently here, but that's really just me being conservative because I need to be careful. Iron ore, Dalian iron ore came in quite strong. Gold is holding its level. Both are important markets for the Australian dollar. So if the Australian dollar sees some strength, I need to be careful in that trade. As always, I'm a bit aggressive, but it is what it is. Usually I get the direction right every time. And then stop loss is 93.97. If you want to be more conservative, go above the big figure like 94.03 or 94.07. I think that concludes this series. I don't know if you guys over at Admiral will say something about that. If not, I leave it to you. It's your series. But should this be the last webinar together, I want to thank Admiral. I want to thank my traders for supporting it. And I want to thank everyone who's not one of our traders to come in on a Monday morning. This has been super fun for me to do. Actually, excuse me, really disciplined me to do my work for you in a hopefully good visual manner so that you will get some insights on how institutional traders look at the markets and trade the markets. Thank you sincerely for our time together. It has been my pleasure and my honor, and I wish for you to make a lot of money in this beautiful, great business. Thanks a lot, and talk to you soon. Bye-bye.
Yes, thanks, Jay. It is true. The series is going to come to an end. I'm not entirely sure when you will be informed or in what way you're going to be informed, but it is going to come to an end, and there is going to be a new format in a way, which you will be informed about. Right, thank you very much, Jay. Thanks for the comprehensive analysis, and thanks to you guys for listening. Have a good week ahead. Thank you very much, guys. Bye-bye.